quarterly market update. Just as a few housekeeping items, you are able to download the slides. So if you look at the top right-hand corner, there's an icon with a paper clip. You'll be able to find the slides there. You can follow along or download them for your future reference. And you can also ask questions throughout the presentation. We want this to be interactive, so you can ask some questions throughout, and we've also set some time aside at the end. And we're also recording this session, so if you can't stay for the full time, we'll be sending out a link so that you can review it in your own leisure time. And so with that, let's dive in. So actually, before we dive in, let's go through some important disclosures. This is all meant to be very general education. This is not individualized, specialized advice. If you ever do want to make changes to your portfolio, have those kind of discussions, we always heavily encourage you to speak to your advisor before making any changes. So keep in mind, this is all very general and not unique to anyone's specific circumstances. So a little bit about today's presenters. My name is Yesenia Realejo. I am a senior wealth advisor, shareholder, and director of financial planning. I carry a lot of hats here at Tobias. I work very closely with our clients, and I also work with our financial planning team who help support our advisors behind the scene and just making sure all of our advisors are giving consistent advice across the board, and we're really staying on the cutting edge of all of the advice that we are offering.
Yesenia, thank you so much, everyone, for having me. I'm Chad NeSmith, portfolio manager at Tobias Financial. I've been here about 5 years. I don't have near the titles that Yesenia has, but I'm here to talk about the portfolio, talk about the market, how to incorporate it within your financial plan. It's a really nice that we have Yesenia here to talk on the planning side. That's going to be really great. But I do have a planning background. I do have a CFP like Yesenia, but also I'm a chartered financial analyst, and really excited to see what we have to talk about today. Oh, I skipped. Sorry.
And so for those of you who aren't familiar with Tobias, so a little bit about Tobias Financial Advisors. We currently have over $1 billion in assets under management. We crossed over that big milestone this past year. We're very happy about it, and really just because it means we get to serve so many different clients. We work with 350 clients across the country, and all of our advisors are certified financial planners. We have a total of 26 employees, and we have been in business for 45 years. So since 1980, we've been around for a little bit.
I think we're middle-aged. 45 years. Yeah.
So today we're going to talk a lot about investments, what's going on in the markets, and general environment. But overall, we want to make sure that as we go through this, we want to focus on some of those things that you can control. One of those things is timing the markets. We don't believe that anyone can consistently time the markets, and so having a globally diversified portfolio is extremely important. And even more important than that is you want to have a plan that you can stick to, both in the good times and in the bad. Whenever we put together portfolios for our clients, we want to make sure that it's something that's going to make sense in their specific plan. And that's one of the things you can control is how are we allocated. We also want to minimize taxes as much as we can, reduce expenses and unnecessary turnover in portfolios. So even though there's a lot of news out there, a lot of headlines, makes us kind of nervous, a lot of the uncertainty, keep in mind that there are core things that we do have control over, and that's really what we want to focus on. So today's agenda, we're going to start by going through a market review of 2025. So how are the different asset classes performing both this year and in Q3? And talk about historical market performance. How are assets doing in light of what's happened in the past? We're going to go into a few topics a little bit more in detail, go through that economic update, a market deep dive, and then also talk about what we're expecting through the end of the year and some of our outlook and insights. And sprinkled throughout, we do have a few various topics, a few questions I'm going to be asking Chad to shed a little bit more light on. And so with that, I'm going to start with one of those questions before we get into our market review. So Chad, something that I hear a lot is taxes, right? People don't want to pay that much in taxes, and we're diving into year-end tax planning towards the end of the year. But something that I think a lot of us don't talk about enough is how are we being tax efficient when we're designing the portfolios?
Yesenia, that's a great question. Thanks so much for passing that my way. And I'll ask you maybe a planning question in a little bit. But as far as on the investment side within portfolios, we are finding opportunities to add more tax-free bonds to portfolios in certain cases. For those clients where we may not have those bonds shielded in tax-preferred accounts like IRAs, we are finding the municipal market or tax-free bond market very attractive. Now, it's not appropriate for everyone. Those are in lower tax brackets. It's not appropriate for because these bonds do have a lower absolute yield. So while we may be able to pick up 4.5% on taxable bonds, the municipal side is more so in the threes. So you are giving up a little bit of raw yield, but when you adjust that for tax for your after-tax return, it looks really attractive. So we are finding more opportunities there. The second one is we're always tax loss harvesting. So in April, when everybody was going wild about tariffs and we were scared that not say we, but the market was scared that we would maybe roll over into recession, we were in the portfolios tax loss harvesting. Any opportunity we got to sell something and to get a tax benefit for our clients and maintain exposure by buying something similar, we did, where the juice was worth the squeeze. Also, what we do that a lot of other planners don't do is we actually practice asset location. And other financial advisors will say they do tax loss harvesting, but they may not do it very well because we see it in the statements that come our way from outside planners. But consistently, we don't see them doing asset location very well at all. And that's where we try to shield ordinary income in tax preferred accounts. So IRAs, SEPs, any kind of retirement accounts, 401ks, we may tilt those more to fixed income to shield that tax burden from you and maintain equity exposure in more of your taxable accounts. We also may invest Roth accounts more aggressively because we want those after-tax dollars to compound at a higher rate for you. That's a super powerful tool that a lot of financial planners aren't using. We also utilize, in some cases, direct indexing, where we may want exposure to the S&P 500. You could buy an ETF, or in certain cases where it makes sense, we would actually go and buy the individual stocks that make up that index. And then that creates a greater chance of harvesting tax benefits for you because some stocks are always going to go down in the markets. And the market makes up all the collection of stocks, but there's almost always a tax benefit to be had in direct indexing. Now it's very, we have to be very choosy when we use it. So it's not for everyone, but in certain cases, we do find a benefit there. Now, Yesenia, I'm talking about what we're doing on the investment side. What are some things we may do on the planning side to help the tax burden of the clients?
Absolutely. So if we're looking at year-end tax planning, which we're about to dive into, is going to be a separate seminar, shameless plug, on year-end tax planning. So if you want to get more in depth on what some of those strategies are, we can definitely listen in. But a couple of them are charitable planning. We've had an amazing year this year in the market. Chad's going to go a little bit more in depth in that. And for those who are charitably inclined, using appreciated securities to donate to a donor advised fund is really ideal because you don't have to pay capital gains on the appreciation, but you can still get to deduct the full fair market value of the asset that you're donating. So it's a very effective way of getting the most bang for your buck and really just avoiding capital gains taxes on some of those appreciated assets. But of course, if you're charitably inclined, that's a really good strategy. Earlier this year, Roth conversions, when assets are depressed, we talked about tax loss harvesting, how we do that throughout the year. What if someone doesn't have a taxable account? If we know that a Roth conversion is something that we're going to do year after year, it's a good idea in the grand scheme of the plan for a client. We could take volatility as an opportunity to do a Roth conversion of depressed assets, move it to a Roth, knowing that it's going to increase over time. So those are just a few strategies that we could take advantage of. I'm going to say in year-end tax planning, but also throughout the year.
Thank you, Yesenia. And that's just the nice thing about coming to Tobias is we work both the investment and the planning side together. We're a team at the end of the day, and it's constantly I'm asking Yesenia about clients where I may want to sell some stocks, and I may ask her, hey, should we give this to charity instead? Should we explore that path? Is the client charitable at all? And if that's the case, then maybe we do that for them. But thanks, Yesenia, for that question. We'll have a couple more further on, but now it's my turn to get into the markets. I'm going to flip over to the screen of green, I guess, here for now. We have a couple of screens of green. This is the third quarter 2025 market returns. As you can see, a lot of greens. This was a very strong, sorry about that. That was a misclick on my part. Very strong quarter in the market. It's actually the second strongest quarter we've seen in the last 20 years. The US stock market was up about 8% for the quarter, and international stocks were up about 5%. Emerging markets up 10. I mean, this is an asset class that has been rather dormant over the last several years, and a lot of people had been soured on that asset class, but we maintain exposure in portfolios, and now it's finally paying off. It's one of the best performing asset classes of the year. We'll cover that a little bit later. Global real estate turning around at 4%. So it had a little bit of a weak 12 months that we'll talk about. In the US bond market, up 2%, and global markets up about a half. So global bonds, not as well as US bonds, but it's kind of, you never know what you're going to get on the bond market side on if US and global markets are going to perform better. So really nice quarter and very strong quarter for the markets. Moving along to further historical performance, just you can see how important it is to stay invested. That's the point of this slide. Over the last year, the US stock market was up 17, international up 16, emerging markets finally paying off again, up 17. Global real estate over the last 12 months, down about 1%. Some of that's still some COVID unwinding that we're seeing, but hopefully we're getting towards the end of that unwinding, and we'll see some good performance on global real estate going forward. US bond market's up about 3, a little bit less than 3, with interest rates higher. We think that the US bond market's going to continue to perform and add diversification to portfolios, and so it makes a lot of sense to maintain exposure there where you want to risk off. Going back though in time, the last 5 years, 15 or almost 16% on US stocks is really strong performance. International, giving you double-digit returns over the long-term average of the S&P 500, which is also really great. When you combine the fact that you can allocate both to US stocks and international stocks to risk off, to help hedge those bets over time, it really plays to have a globally diversified portfolio when you think about a risk-adjusted return basis. Now, one of the 2 red blotches you see on the screen here is the negative 0.5% return we're seeing for US bonds. That's because bonds were down a little bit over 13% in 2022, but we are recovering from that slowly but surely. We're not expecting that to repeat because interest rates are higher. Right now, the 10-year Treasury is paying 4% and corporate bonds are paying a little bit higher. So we're expecting longer term returns to be more in line with that. And then as you go down towards the bottom of this page, you're seeing just the benefits of staying invested over time, even though there's been a lot of volatility short term with COVID, this goes back 20 years. So this is pre-Great Financial Crisis. This is 2005. This is what we're looking at here. Still a 10% return on US stocks, 11%, even going through the Great Financial Crisis, which is wild. And then bonds paying 3%. So this is really good about when we talk about financial planning. This is what we're trying to hit these average returns in blended portfolios to help give you successful financial plans. I think that this 20-year chart shows that really strongly. We're going to leave this page of green to show you another page of green. This is the year-to-date asset class returns through 9/30/2025. As you can see, a lot of green here. Some years we get a lot of red, but this is a green year. People wouldn't have expected that, thinking back in April when we had the tariffs coming through. But leading the way is Mexico, up 50% through 9/30/2025. Then just below that is gold. Extremely strong performance from gold this year. We'll talk a little bit more about gold later on in the presentation. We have a slide or 2 dedicated to that. And then China. People were really bearish on China last year, but it's rebounding really strongly and pulling up the emerging markets section of portfolios. China and Taiwan make up about 40% of emerging markets. And so that's really strong performance on that part. Germany, Canada, we go back further down to just general international stocks, up about 26%. So it leads to wanting to be globally diversified. Really great to see strong performance from international after the last 2 years of underperformance versus the S&P. The S&P also nothing to scoff at it, almost 15% for the S&P 500 through 9/30 of this year. Given where we were in the depths of it all, especially the Russell 2000 small caps, as we can see, up over 10. At one point, small caps were down 15% year to date. But the fact that we're having lower rates going forward and good earnings out of small caps and large cap stocks, it's really turned around in that 25-point swing from down 15 to up 10 at one point this year. I think that's really promising and strong. And then as we get down to the more consistent returns of bonds, up 6, US Treasuries up 5.3%, I think really promising. And now normally when you see red, you think, man, that's not good. Things are down. But it's crude oil, meaning if you are a driver of cars, which I think most of us are, we're paying less for our gas. And I felt that on my commute to Disney World this last weekend with my son. Gas is cheaper, and I think that OPEC is really increasing production, and we're seeing the easing of tensions in the Middle East being great to help that. That being said, we have added some allocation in our portfolios to crude oil as a mixture within a real return strategy that I'll talk about a little bit later. But this is year-to-date asset class returns. Just overall a really great year. I'm going to talk a little bit about volatility within portfolios. This chart goes all the way back to 1980, and this is looking at the S&P 500, looking at the bottom of the barrel where the red numbers are how far down from top to bottom we went in 1 year. So going to the far right of our screen with my mouse, at one point this year we were down 19% on the S&P 500 from the tippity top in February down to the bottom at the beginning of April. And so far it's recovered back. Now this is plus 13 because this chart is through October 15th. So a little bit different than the 930 chart we looked at previously, but it just shows the resilience of the stock market over time if you're patient. That in 2020 and COVID, I mean, this is crazy that we were down 34% at one time in COVID, but still ended the year up 16% on the S&P 500. I say this all the time to clients of, if you could predict COVID happening, what would you think the stock market did that year? If you said up 16%, I mean, I would have gotten that wrong. So you can't predict what the market's going to give you back, but what you can do is manage risk and create a plan with people like Yesenia and stick to that plan. So I think we may have, take a pause. That was the market overview. We have a little discussion question. I'm going to throw it back to Yesenia real quick.
Yes. So Chad, another topic that I'm hearing a lot about from clients is AI. If you haven't been hearing about AI, it's because we may be living under a rock, right? It seems to be everywhere. And so overall, what are you seeing when it comes to AI, not just in the market, but really what is the influence of AI in our world today?
That is a great question. I use LLMs every day when it comes to research. I'm also trying to stay on top of the improvement rate that I'm seeing within large language models and artificial intelligence, just so I can have a grasp on it when it comes to an investment perspective. I am seeing improvement in what they're doing. The answers I'm getting back from these models are improving. Still, though, there are errors in them. However, we're seeing what they're able to do in video and audio right now is actually pretty terrifying, where if a bad actor got a hold of even this webinar or a video of me, they can impersonate me, where they could record my voice and record my facial gestures and send a video to someone like my mother or my father and say, hey, I'm in trouble, I need your help. Please send money, Bitcoin, to this address. I mean, these things are, what we're seeing is a pickup in fraud with using artificial intelligence, not only in email, because they're able to utilize LLMs to sound more believable, but also in audio and video, where you may get a phone call from a number you don't realize, and it's someone impersonating someone that is real, but this is actually artificial intelligence.
I know, Chad, I'm getting phone calls all the time, and you never know if it's daycare, so you got to pick it up, and no one answers the phone. It's just quiet. So I'm convinced that they're trying to record my voice for, one of these bad actors to use in that manner. It just seems rampant nowadays.
Mm-hmm. I mean, it is wild. Are you taking steps to help protect against that personally, Yesenia?
Yes, when I get that phone call, I don't talk. I just say hello and wait. I don't keep talking after that. But really, another scam that we're seeing all the time is people calling, like you've mentioned, someone's using your audio or your video to call a family member and say that you're in trouble, they're demanding money or something like that. Or they're pretending to be a government agency. You haven't paid your tolls. Goodness knows, if you look through my phone, I haven't paid any of my tolls in the last few years. They make it seem that way, and it's very urgent. So our best advice to help protect against this is to just hang up the phone and call the source. They're always going to make it seem like you can't call back. They need an answer right away. Just hang up. Hang up. It's almost guaranteed. I can't say the word guarantee, especially in a webinar, but if someone is putting a lot of pressure on you to give you a quick answer, it's very likely to be some sort of AI fraud or scam. So just hang up the phone, call the source. Know that government agencies are not going to text you or call you. They're going to send out old-fashioned snail mail. That's how they're going to contact you. So this happened with my own aunt via Medicare. They knew that she had just gotten her Medicare card and wanted her number to activate it. And so what did she do? She gave them the number to activate it because she wanted to make sure it still worked. Thankfully, it's Medicare fraud. They're not taking money out of her account, but still, right? That could have easily been her social security number, things like that. It's very believable. So just hang up the phone, call the source as a way of double checking. Another way is to have a safe word with your family. Hey guys, family meeting. If something happens and you need to verify whether it's me, this is the word you ask for. Have a passcode. My mother-in-law actually sent us out one a couple of months ago, and she said, if anything happens, this is our family safe word. And we all thought it was hysterical, but she told us why, and we're like, oh, it's actually a good idea. So highly recommend all families have one in place as well.
Yeah, I think those are really great tips. And we're seeing, the video quality that's coming out of artificial intelligence is wild. We're actually seeing a lot of these actors make fake websites where they could say, hey, you're going to send money to this address. It'll show up on this website. And that website looks legitimate. So be very careful about anything that claims any kind of authority, and just hang up the phone and call. And utilize these tips. And if you have any questions, please reach out to us or your advisor. This is something we're paying really close attention to. So just some tips to protect yourself as we move along to the economic update of the section of the webinar. We have one of my favorite graphs I'm going to show here. This is a long-term graph about inflation. It goes all the way back to 2018. So it is pre-COVID. So it's pre that 9.1% inflation you're seeing in 2022 when we had both inflation in goods and services and at the pump, which was just wild that it was all stacked on top of each other at the same time. As I said, the blue bar, the dark blue bar we see on the screen here, this is the housing inflation. We thought that that would just continue to decline over time, and we are seeing that as the data rolls off in a 12-month rolling window. Also, auto insurance, the growth is also coming down. So that's easing inflation pressures right now, which is really nice for the consumers. There's a couple things that we're seeing though as bubbling up. The first one is the core goods. We're actually seeing in the orange, this is the tariffs coming in. So we're seeing some goods inflations due to tariffs. The average tariff we're paying right now is about 17 to 18% on anything imported. And that's just rough numbers. So it's obviously some goods are higher, some goods are lower, but just to give you an idea of what we're paying on imports. The second thing that is not going to show up here that's going to feel like a lot for a lot of lower income individuals is the expiration of healthcare tax credits, where if you are given a subsidy on your health insurance, that may be going away with the new government budget. And a lot of individual taxpayers are going to feel that, but it's not necessarily going to show up in the inflation data. I'm going to be monitoring that to make sure that it doesn't disappear in other parts of spending. So we may actually see a reduction in consumer spending because of that additional. It's almost like a tax because it's a subsidy that goes away. But overall, inflation is bubbling up just a little bit, but it's temporary because tariffs are by definition a temporary thing. Given the level of tariffs is much higher than the previous administration, 2016 and 2019, I expect it's going to take a little bit longer to work its way through the economy than prior, but still be a one-time event. So don't get too scared if you see inflation bubbling up again. We're monitoring it very closely. That is the story of generally what's going on there, though. Talk a little bit about jobs. Now, I'm a little saddened because the government shut down. I did not get my government jobs report that was due to me a couple of Fridays ago. However, ADP is a payroll processor and they release a jobs number that's just before the one that comes out from the official government. That, and we had such a large downward revision recently with the government saying we actually added 1 million jobs that we didn't add. Leads me to like the ADP number more anyways. So what ADP is saying that for the year of 2025, this is private sector only, this doesn't include government jobs, we've only added 327,000 jobs for the year of 2025. Now, 327,000 was a really strong month when we talked about 2021 and 2022. And they're saying that that's what we've added for the year net. Now we've lost jobs. Now they've recently said that job growth have been slowing, but in September we actually lost 32,000 private sector jobs. And another thing they said that I found interesting was that smaller employers are losing more jobs, and the net larger employers, 500 and above, anybody who has 500 employees and above, they're actually the only people gaining jobs right now. They were up 55,000 in the month of September. And so that's something that I find really interesting, is that the small businesses are actually struggling a little bit more than the larger corporations. And that's a trend I expect to continue. And so it's going to be really interesting on our job market when these bigger corporations really start to see the benefit of artificial intelligence and scale of their business, that the employment picture could suffer a little bit even more. However, the good news is it gives the Fed a really good reason to keep interest rates low. Even in the face of tariffs, even in the face of higher inflation, the Federal Reserve has a really tricky job right now in balancing both inflation and employment. And since we have such a structural matter with artificial intelligence right now, it's a job I don't envy from the Federal Reserve, but it's a nice, they're going to eventually find a nice balance here. On the right side of your screen, we see a graph that's from the August report. This is the last report we got from the government that includes government jobs. This is year to date. Actually, this is a 12-month net change. So this is August 24 to August 25. This is something I talked about in my last quarter, where a lot of the jobs we added were in education and health. That was the vast majority. And leisure and hospitality was in second place. Apparently the government can really feel the cruise I went on in last couple months for adding leisure and hospitality jobs. But a lot of other industries have not added jobs. So logging, construction, manufacturing, retail, trade, I mean, a little bit here, but I would expect them to be more. And health services and education are just becoming a larger and larger portion of our employment base over time. But it's something I'm monitoring. And overall, employment has been weak, but not recessionary weak. That's a big difference there. So it's not, we haven't seen massive job losses. September is the first net negative loss jobs I've seen in a very long time. So it could just be a 1 month thing. Now, if we talk about maybe 3 months in a row that we're losing jobs, maybe we look deeper into that report and think about what's going on in the overall economy. But overall, jobs are slowing, but spending on artificial intelligence is really boosting our economy. That's why we're seeing strong GDP growth. So on this slide, we talk about data center and artificial intelligence spending. This is a chart that goes back to, this is fixed capital investment that goes back to 2018. And this breaks out anything spent in the technology space. So this is communication software, IT is in the blue here. And then R&D is research and development. So if they're looking to design a new product, this is where that R&D spending would show up. And then we have anything else, any other thing. So as we can see, anything that's not gray is really kind of tied to technology spending. And we're seeing that the last 2 years, technology spending has more than made up for everything else in the growth of capital expenditures. And what's really interesting is that JP Morgan said that artificial intelligence capital expenditures added 1.1% to GDP in 2025, which is roughly a third of our GDP is just in AI spending right now. So it's really helping. The good thing also about this is a lot of these spending, their commitments, and they're not slowing down. So we are expecting this to continue for the next several years because these are contracts that are locked in for the most part. So that's really nice. And AI spending is not slowing, but there is a tale of two economies where you have the AI spending, which is propping things up, and then the deceleration we're seeing on other parts of the economy. But net, we're still really positive on GDP growth, and we don't see a recession over the next 12 months because of it. It's just a different economy than we had in the past. I just want to highlight that for you guys. So that has to do with the economic update. I think we are going back to Yesenia for another question.
Yes. So Chad, another question or topic that I'm hearing a lot about from clients, especially this past year, has been gold. What are your thoughts on gold? How are they being incorporated in portfolios? Yeah, overall, what are some of your thoughts regarding how this can be incorporated and what people should be doing with regards to gold?
That's a great question. We have gotten a lot of questions about gold, particularly because it's up so strongly this year. It's almost like we're seeing panic buying, and I'll talk about that in a couple of slides. I've got a really nice slide for you guys on gold. But in portfolios, if you're going to own gold, I would consider owning it in a small amount, but then you also have to hold it over a very long time period, because gold has this thing where it can be up 50, 60% like we're seeing this year and then do nothing for like 8 to 10 years. And that's just historically looking back over the last 20. We saw this in 2011 where we saw gold run. And then from 2011 to I think it took until maybe 2018 or 19 until it reached its 2011 highs again. And most investors don't necessarily have that kind of patience when it comes to gold. Personally, on our portfolios, we don't own, we own a very, very, very small amount of gold, less than 0.25% in portfolios. And that's just because it's wrapped into one of our real return strategies where we own assets that we think have more consistent protection of purchasing power. Gold has an inconsistent protection of purchasing power where it can be up 50%, it can be flat for a long time, where you're spending money all of the time, and we want something that's going to be more in line with inflation. So we recently added a real return strategy to the portfolios that includes some oil exposure, that includes commodities like lumber, corn. I mean, it's just a big basket. Also has some infrastructure stocks in there and some treasury inflation protected securities that actually pays out a higher income whenever inflation picks up, like we've seen here in the last couple of months. So we think that that is going to be a better track for inflation protection and for real returns, and is also going to give us a much lower level of volatility than what we're seeing in gold right now. So because if gold can be up 60% in a year, it can also be down 50 or 40 in a year. It's very possible. And it's just one asset, and it's not necessarily an investment because it's more of an asset class. And you may be seeing more advertisements for gold right now because of people are able to advertise gold without it being without getting into securities laws violation, because gold is not a security. It's not it's more of an asset and not an investment. So be very wary whenever you get a phone call from somebody trying to sell you gold or silver. It's a very bad protector of wealth if held in short periods of time, where most investors hold it. You have to have a really particular strategy with gold that I would love for you guys to call us about. If you have questions about it, we'll happily take that.
Awesome. Thank you, Chad. Really appreciate it.
Now, I think there's also maybe some other things to consider when you think about maybe tax planning around gold that we maybe want to cover a little bit.
Yeah, so given the great year that it's had, I do have some clients who were very adamant about it. Last couple of years, they really just wanted gold in the portfolio. And like Chad said, it's had an awesome year. It's effectively doubled more than, or gone close to doubling. And so now we have this really high appreciation in this asset class. What do we do with it? If you sell it, let's say we want to de-risk, trim some of our exposure, note that you're going to pay 28% collectibles tax. This is not the regular capital gains tax rates that you're looking at of 15, 20, or 23.8%. You're looking at 28%. So it is more expensive to sell out of after you've had this appreciation. So just kind of going back to what I was mentioning earlier about donating appreciated assets, this might be the asset to donate if you aren't charitably inclined. And that'll be a really nice way to trim your exposure and also get a tax benefit by donating it to a donor advised fund. So yeah, since that's just such a powerful asset class, that if you have that already in your portfolio, that might be the one to use. But note that that's only going to be for securities. So if you have gold in a basket, if you have physical gold, that's not going to be the case here. But we do have a lot of clients who have some ETFs that have gold in them, and those might be ideal assets to donate this year.
Thanks, Yesenia. I really appreciate that. It's always nice to tie the planning aspect with the investment aspect, as we are one team. So
they talk to each other. Can't do one without the other.
They really do. So we're going to go. I have a couple of slides on market deep dive that I think are really great. It's one that I've talked about before in the past, is S&P concentration. We saw this bubble up a year ago, and it's becoming more and more of an issue in portfolios. And that is the top 10 companies, if you can see my mouse, are now making up 40% of the S&P 500 per market cap. So when you think about, oh, I've got this money that's going to the S&P, this is this nice diversified basket, $4 out of every 10 you put in the S&P is going to 10 companies now. And a lot of these companies are interlinked, or they're in the same business. We're talking Meta, Apple, Amazon, Google. They're all big tech companies. So this speaks louder than anything else that I can really come up with, and the importance of diversification into international and different market and different like small cap and mid cap stocks and portfolios, just to diversify away from this concentration risk that we're seeing in portfolios. Another thing I've been doing here recently is just rebalancing more in portfolios where someone may be overweight in these 10 companies in portfolios. We talk a lot about how good they are on the upside, but they can really whipsaw on the downside, especially when the market is pricing in such a high growth rate for some big tech companies. Overall, the top 10 names, you're paying about 50% more than the rest of the S&P 500 on a price to earnings basis. So for every dollar of earnings, you're paying $30 for the stock. For the rest of the S&P 500, for every dollar of earnings, you're paying about $20 for the stock. So it's a little bit more pricey just because that growth rate, the projected growth rate is higher. But my job as a portfolio manager is to manage risk when it comes to financial plans, and this is a risk that I am paying really close attention to. We're going to move on to just the Federal Reserve. What's going on in the Fed? You maybe have heard that interest rates are coming down, and we are seeing that. Rates are coming down. The Fed is going to cut, and they're continuing to cut rates. We think they're going to cut another quarter point here in the next week or two. And there's several different areas we could be in. I think we're personally in the top left sector of this, where the Fed is cutting rates and there is no recession within the next 12 months. And that happens in about 5% of outcomes. Now, most of the time the Fed is on pause and the economy is kind of churning along and there's no recession. But as of right now, the Fed is moving rates and they're cutting rates. And in this scenario, it's the strongest return on stocks that we've seen when you look at all previous historical metrics. Now, you can't say that past performance does not equal future returns, but this is a nice hint as the risk return that we may be taking when, even if there is a recession, stocks in the last 7% of time periods were only down 1.9%. So we're not forecasting a recession, but bonds have historically performed well in both scenarios. And most portfolios have a combination of stocks and bonds in them. All of our portfolios do, and they will benefit. The bond portfolio will likely benefit from this because when Fed cuts rates, bond prices move up and move higher, generally speaking. And so I think this is really nice and a really good news for just overall, just the message of staying invested and sticking to your plan, because we don't know the timing of returns. We don't know when it's going to happen, but over time, over a long period of time, stocks do well, bonds do well, and that makes plans do well. It's just our job to manage the risk and return profile. So that is it for this slide. I'm going to have a slide on gold here that is, I think, rather interesting. And this is a slide that shows historical volatility. And this goes back to the end of 2015 to 2016. This chart shows what the market expects certain asset classes, the volatility, a measure of that. So up and down movements, it's saying. Now, when you go back to 2020, the market said, wow, we have COVID. Stocks are going to move a lot. That's what that means. That's the orange. The orange is the S&P 500. Purple here is gold as an asset. When COVID happened, the market said, hey, stocks are going to move a lot. Gold is also going to move a lot just because everything's moving a lot, but still less than stocks. And historically, we're seeing, yes, that's the case most of the time, that stocks are a more volatile asset class, the S&P 500, than gold is. There were some little tidbits where gold may have done a little bit. However, what we're seeing is, I think, really interesting, where gold has really run up a lot, where the market is saying, hey, stocks are going to be about historically where they were. However, we think gold is going to be more volatile than what we've seen going back to COVID. That's what it's pricing in right now. So it's almost like it's saying, hey, this asset is going to move a lot in price. And that nice smooth price return that you're used to in gold, that's not really going to happen here. And so even though it's up 62% year to date, it's pricing in higher movements for gold than stocks, which if I were an investor and thinking, wow, I'm going to risk off and buy gold, you're kind of doing the opposite here with what the market's pricing in, where it's saying it's riskier from a up and down price movement perspective. And it's almost if gold is signaling a recession, but we haven't seen it yet in the data. We've seen a deceleration in some parts, but it's already pricing in like we're going to go into a recession, even though that's not the case. And that's not our base case. It's a bias. And so it's kind of, I think gold's getting ahead of itself right now, where we're seeing almost a panic buy, where those that have not gotten in for so many years because gold hasn't done anything are going, well, maybe I should really consider adding it to my portfolio. But I would be timid to add it to portfolios right now, considering what we're seeing in both volatility and absolute price movement we've seen year to date. So that is what we have to say on gold. I think we're going to move on to just 2025 outlook and insights. I'm talking about portfolio positioning, just what we're doing in different asset classes. I think this is a really great slide that we add at the end of the webinars. On the fixed income side, we're keeping duration slightly shorter, maybe just to maintain. We've had a lot of interest rate volatility this year, and we think that the shorter end of the curve gives a really nice risk return benefit. So we're slightly shorter than what the overall bond market is. So our bonds go up and down a little bit less than what the overall bond market does. All things kept constant. We maintain very high quality. We're mostly treasuries at this point. And we think that it's just a really nice, consistent risk-off play. Now, I mentioned earlier municipal bonds. We are starting to incorporate more of those in select portfolios. We do think that in some client cases, the risk return and after-tax benefit makes some sense. However, just certain parts of the municipal bond market make sense. Not all of them. You may see where on the shorter end of the curve, we don't think it makes sense in a lot of cases. But as you go further out, you're getting paid a lot more when compared to treasuries. And we think that's really nice. That's why we're adding it in some portfolios.
And
On the
Chad,
stock side,
and if I could add there, generally speaking, those of you who are in higher tax brackets, that's when the municipal start to become more attractive. So it's not an absolute, we like munis. It also is paired with what tax bracket are you in? And then also what tax bracket are you in for any given year? This is something that we evaluate on an annual basis per client. So every year we look at not just what tax bracket are you in this year, but are you going to have an event? What tax bracket are you going to be in next year? So we really pair those two items to see if that's what makes sense for each individual client.
Thanks, Yesenia. I really appreciate you adding that color there. It's really important when you think about incorporating municipals in your portfolio. So I really appreciate that. On the stock side, we're rebalancing where it makes sense, which right now in a lot of big tech allocations, when they get a little bit overweight, we may be chopping them a little. We may not be letting them run as much as we had in the past, just because of that concentration that I talked about earlier with those top 10 holdings. And we're keeping a close eye on the big tech part of portfolios, just because a lot of those companies are moving in a way where they're highly correlated, and we're at the end of the day risk managers. So it's something we're keeping a close eye on. On the opportunistic side of portfolios, we have real estate in the portfolio. That's real estate without office exposure. And we have hedged equity, which is S&P 500 exposure. However, it pays you a little bit higher income in that sleeve, which is a nice hedge to portfolios. And we recently replaced floating rates. So floating rate treasuries, when interest rates move down, it's just going to pay us less money. So we're more inclined to go into other asset classes now that we think rates are going to move down. And so we've introduced a real return strategy that incorporates treasury protected securities and oil and the infrastructure that I talked about earlier. So that's what we're doing in portfolios and different asset classes and fixed income stocks and the opportunistic side. Let's talk a little bit about the good things that we have. What are things that we may be optimistic about going forward, the last little bit of 2025 and then going into 2026? Like I said earlier, the Fed cutting interest rates. We think they're going to continue to cut. The market's pricing in another maybe 3 to 4 cuts over the next 12 months. This really incentivizes those that have held on to cash to get that invested in other parts of the portfolio. Please reach out to the advisors should you have some cash outside of us. We're also monitoring on our side for looking to put that to work. This is another thing we're optimistic about is global diversification, working really well in 2025. International exposure in portfolios is really paying off this year and providing the returns that it should over the long term. Another thing, AI spending is supporting the economy and it's maintaining. We're thinking it's going to continue at the current pace for an extended period of time. And overall, it's going to prop up GDP growth and prop up the economy. So that's really great. And then lower interest rates. We think rates are going to continue to decrease. Like I said earlier, it's going to help small cap stocks because those small cap companies finance at a floating rate. They finance floating rate debt. So most of the companies, when the Fed cuts rates, they don't necessarily benefit. But smaller companies, when you finance at a floating rate, when the Fed cuts interest rates, they pay less interest on their debt, which helps their business. And overall, we think it's going to help small cap stocks. So it's great. Now, things we may be cautious about is that stock valuations are lofty versus historical levels. Now, when you think about historical levels, we haven't really had many markets where 10 stocks make up 40% of the S&P, and they're all tech companies. So some of this is not, we shouldn't be comparing this market to historical market levels because the businesses are different and the business types are different, the growth rates are different within these businesses. But it's something we can be cautious about and we want to keep an eye on. Private payrolls, it's jobs. It's showing signs like I talk about slowing, something we're watching. China, US tensions, they are increasing. We're seeing both the United States wanting to get more independent on producing things, not outsource to China as much. Same thing with China, they're doing other things. We saw recently about the rare earth materials that they were looking to potentially the rare earth materials not letting us import those. And then outside of AI spending, economic activity has been rather modest, not recessionary, but modest. So something we're definitely watching. But those are the things, that's what we have prepared. I think we did have a Q&A section, but I don't necessarily see any questions. Yesenia, do you see anything?
I did get a question. So we did get a question. Do you have any comments about the investment in annuities and do you recommend them? And so great question, one that I get often. For most people, I think annuities can be a very expensive way to get that stream of income. That's generally how they're sold. It's a guaranteed stream of income. They're low risk, not subject to the market. Some of them are, not all of them are. So I think it's very unique to a person's individual situation. I think they can be great for those who maybe spending is an issue. If we just have full access to a full portfolio, we're just very tempted to take more and more to a point where it's not sustainable. Maybe it is a better idea to have some in an annuity and we're living off of a fixed income. I think that could be really good for some people. I also have some clients that the only reason they can deal with the volatility of a portfolio is because they do have some annuities on the sidelines. They know that they can tap into those if they need to. And that helps them sleep at night when the markets do get a little bit volatile. They just weren't very used to investing, so they have a bit of a mixed strategy. So I think in some circumstances, it does make sense, but it can be a very expensive way to access the market. I have some clients who say they're very safe, they're guaranteed. Not the indexed annuities. They are subject, the actual product is invested in the market, the same thing that they were trying to avoid. And so I think when it comes to annuities, it's just very important to understand what an individual's goals are, what are we trying to achieve, and what's the best product for that. We're not a huge fan of products because they're expensive. Products have additional fees and commissions that we like to avoid. We're fee only, we don't sell any of these, but they do have a place in some people's portfolios. So it really just comes down to the goals. What are we looking to achieve? And again, how do we minimize costs? That's one of the things we can control. We want to minimize cost. Annuities can be expensive. So we want to see what the different trade-offs are. So I have to give the non-answer of it depends. Great for some people, not so great for others. But highly recommend you reach out if you have specific questions about your situation. I'd be really happy to go into more detail and see if that's something that works for you. Chad, did you get any other questions that came through?
No other questions.
All right.
I appreciate your answer there on the annuities, but I don't think I have anything else other than thank you so much for attending. Yesenia, do you have anything else you want to say?
No, that was all. Thank you all so much for joining us. Really happy to be here and join you, Chad.
All right. Thank you so much, everyone. Have a great day.
Bye.